So hi everyone, welcome to Bharat Alternates. Today we have a episode. Today we are at episode 2 of Fund Manager Talks, and today we have Mr. Darshan Engineer. So welcome, Mr. Darshan. Uh,
Hi.
Hi. So let me just introduce you, Darshan, and then you can take over from there. So welcome, Darshan. Darshan is having over 16 years into portfolio management services and alternative investment funds and across the markets. He has worked with various companies like Alchemy Capital, Karma Capital Advisors, Value Quest Investment Advisors, and now finally you are the fund manager at Sundaram Alternates. Heading their PMS strategy, managing their PMS strategies. Your experience is very relevant in today's volatile market, which is very volatile, and yet we have couple of opportunities that we see. So Sundaram has multiple offering across their PMSs. I think they manage more than 4 or 5 schemes. They have a scheme called Voyager, then they have SISOP, Rising Star, Self, etc. And Sundaram is also known for its debt credit strategies as well. So our audience today includes high net worth individual, ultra high net worth individual, family offices, and NRIs. So we are very keen to understand from you how Sundaram is thinking, positioning, and managing risk in today's macro and microeconomic environment. So maybe Darshan, if I have missed out something on your professional journey, you can elaborate a little bit about your professional background. That would be very helpful for our audience.
Sure. Thanks, Gitansh, for inviting me to be a part of your show. I have had a very pretty interesting journey over the past 17 years. So, I actually began as a software engineer and worked in Tata Consultancy Services for 2 years after completing my engineering in computers in 2005. So, after doing software services for 2 years, I decided to change track and decided to do MBA in finance. I got into Jamnalal Bajaj Institute of Management Studies, one of the prominent leading MBA institutes in India. I passed it. I passed my MBA in finance in 2009, and that was the time when the world was in the grip of the global financial crisis, and many students, including even me, struggled to get a campus placement, even from top tier institutes like JBMS. Fortunately for me, RBI was implementing Basel II norms at that time, and therefore, as a part of those implementation, leading credit rating agencies were seeking freshers to undertake large volumes of rating assignments of various mid corporates and small corporates, both on the listed and unlisted side. Basically, they were doing credit rating exercises for the corporate portfolios of various banks. And for me, I got into CRISIL after giving a few round of interviews, and that's where I actually got to learn the real world financial analysis. So what we learn on campus is way different from what we actually do in the real world. But that helped me to do company analysis from various angles, be it business, financials, or even management analysis. And after spending almost 2 years over there working on a variety of companies, I got an opportunity to work at a asset management company again in a similar role. So if you remember, 2010 to 11, 12 was the period when FCCBs were in vogue, and a lot of Indian companies, both listed unlisted, would issue foreign currency convertible bonds, and these would get listed on the Singapore Stock Exchange, which was a favorite destination for the FCCBs. And I got an opportunity to work at Alchemy Capital Management, which used to run a FCCB fund based out of Singapore at that time. So I joined them in Mumbai team, and my reporting managers were based out of Singapore. Unfortunately, 2012-13, the rupee depreciated significantly, all the way from I think around 48 rupees to all the way up to even 64 rupees. And you can imagine, I mean, it's a fixed income fund end of the day. So the returns are, you can say, early double digits at best. And you are also using leverage. But because of this rupee depreciation, all the good work done by the fund managers in the past was undone, and eventually it had to be wound down. For me, fortunately, I was equity team in Alchemy Capital at that time, since I was based in Mumbai, and therefore I also started working along with the equity team, which was based in Mumbai, and that helped me get introduced to the world of equity investing. I started as a junior analyst, and over the years, I rose through the ranks and became a core member of the equity team out there. It was a pretty small team, very well. I mean, the funds were very well managed, and it was a small team. Interestingly, so I got a great opportunity to work with all the leading fund managers in Alchemy Capital at that time, and all of those learnings have shaped my investment journey over the years. So after spending around 10 years at Alchemy, I got another opportunity. I joined Karma Capital Advisors. Again, their investing style was way different from that of Alchemy. So while Alchemy was more growth oriented and was willing to buy companies with high PE multiples, Karma gave me a different kind of experience. They were very long term oriented, were value oriented, and were very patient with their investment. So I really got to see different ways of investing while at Karma. For me, interestingly, Karma also gave me the opportunity to manage my own fund. And I would say very few people in our industry actually give opportunity to newbies like me at that time. I got promoted to the role of fund manager after 1 year of working as a senior analyst over there. And I designed a small and mid cap strategy called Lotus, which I managed quite decent. I would say I did a decent job over there. Managed it for around 2.5 years, generated alpha over multiple time periods, and it was a good experience overall. Thereafter, I joined Value Quest Investment Advisors again, which was a different investing style from the previous two experiences. So for me, fortunately, at all my three places, I got to work with great set of people, learned a lot from all of them, and each one different from another, yet relevant and doing well for themselves. So all of this has helped me to shape my investing style, which of course is my own individual style, I would say. But the point being that, I mean, there can be multiple different investing styles, each one different from another, and yet each one can generate good alpha over the long term. So my investing style, from all of this, if I were to distill, I would say that it is doing proper due diligence and deep research on any sector and company, not over analyzing something, preferring simple to understand, easy to understand companies, being patient with your investments, and willingness to bear temporary drawdowns, which will happen from time to time. And finally, building a position over time, not going gung on one company at and building a position overnight, but rather gradually over time. And finally, having a diversified portfolio spread across sectors and companies, so that, I mean, it helps you to hedge, because not all sectors do well at any one point in time, and not all companies will do be bad at any point in time. And finally, one very critical thing which for me has worked is being disciplined in terms of entry valuation. So when you buy a company, you need to ensure that the valuation multiples are not out of it. So these are the three key points for my own investing style, which has worked for me. And I would say all these trends have helped me to arrive at my current working style.
Got it, Darshan. I think, this experience is quite the need of the hour because investors are quite worried. So you have an amazing background, I must say that. Also, if you can run us through, Sundaram as a group a little bit because you have joined Sundaram recently, if I'm not wrong. So maybe if you can spend a couple of minutes and explain the offerings that, Sundaram is having in PMS and AIFs, that would be very helpful for our audience.
Sure. So, first of all, I mean, everybody knows about Sundaram Finance. I mean, Sundaram Finance is a Chennai-based NBFC, which dominant exposure to vehicle finance, both used and new vehicles. It's a very renowned, conservative, and highly regarded NBFC, and its current market cap, if I'm not mistaken, is more than around 50,000 crores, and it has been one of the very steady compounders over long terms. If you were observe its share price chart. So Sundaram Finance has multiple subsidiaries, one of which is Sundaram Asset Management Company. It runs around almost, I think, now 70,000 crores worth of equity book. And so Sundaram AMC used to run a PMS setup also within itself. And it started, I think, all the way since 2008. And 2018, Sundaram Alternates was formed as a 100% subsidiary of Sundaram AMC. This
Okay.
was done to bring sharper focus to both PMS and AIF, and that PMS and AIF need a slightly different approach to the normal mutual fund approach, and that is why it was separated as a 100% subsidiary. And over the years, since 2018, Sundaram Alternates has launched multiple equity and debt or credit strategies under both the PMS and the AIF platform.
Oh,
So Sundaram is, I would Alternates, I would say, is one of those rare firms which has a very strong equity as well as a credit book. As on August 2025, we run around, I think, four different equity strategies under PMS, and we have two strategies under the AIF platform. Uh,
okay.
Similarly, on the debt side, uh, we have got one debt PMS which has been doing well over the past 1 year, and we have got multiple credit AIFs with different risk reward profiles. So that's how the Sundaram Alternates is placed. Just to give you some more details about the equity strategies, so we have got the multi-cap strategies called CSOP and Voyager. CSOP is basically stands for Sundaram India Secular Opportunities Product. Voyager is a slightly more aggressive version of the CSOP strategy. We have a mid-cap strategy called SELF, which is basically Sundaram Emerging Leaders Fund, and we have a small cap strategy called Rising Stars on the PMS platform. On AIF, we have a strategy called Atlas, which is a mirror version of the Voyager strategy on PMS side. And we have got Econ, which is a mid and small cap strategy, more akin to our Self and Rising Stars. So that's how we have created different alternatives for investors interested in equity strategies at Sundaram Alternates. On the credit side, we have got the debt PMS. We have got like performing credit opportunities fund called Peakoff, which has been launched in the last 1 year, and we have also got a series of real estate funds. We have just launched a real estate fund 5, which is all the previous four real estate funds have done very well and have delivered extremely good returns. So that's a brief on Sundaram Alternates as a house and what all strategies it provides.
Great, great. So, as you currently manage PMS strategies, so today we'll be sticking on to the PMS strategies, and obviously we will be also discussing something about global markets. So, maybe if you can take over and talk about some strategies in detail and some, industries, some sectors that you think will do well going forward, some ideas that you have in your mind, and how does a fund manager at Sundaram or you identify companies? Is there a basic thumb rule that you follow, and then how many companies do you track on daily basis, weekly, monthly basis? And how is Sundaram, which is a question that is asked from a lot of investors, that how is Sundaram headed to deliver alpha in the client's portfolio in the next
Uh,
5 years?
Thanks. I would say, first of all, I mean, let's understand how Sundaram Alternates equity team thinks about investing in the Indian market. So we generally prefer growth-oriented companies. So we basically work on the principle of growth and quality investing. India being a growth economy, the companies that are growing fast tend to deliver above average returns for shareholders. So along with growth, if you add a layer of good quality, the returns tend to get enhanced. Now, the definition of growth and quality varies with every fund manager, and therefore, you have a variety of fund managers and investors who are each different from each other, and accordingly, uh, even though everybody says that they are growth or quality investors, you will see there will be a different call on individual stocks or sectors as well. So that's where the subjectivity arises. From our point of view, we prefer high growth companies with quality. Now, the quality, we define the framework in three Q terms. So, what do I mean by three Q framework? We mean quality of business, quality of financials, and quality of management. Now, in business, we prefer companies with high growth in sales and earnings, which cross a certain threshold in terms of return ratios, credit metrics. They form the shortlist of our universe. Thereafter, it becomes a qualitative or a subjective exercise in evaluating management, and valuations again is a subjective call. So, for some fund manager, say a 30p stock would mean expensive. For another fund manager, 30p will be like okay, it's reasonable. So that's where the subjectivity comes in. From our perspective, what we also look at is other factors such as, for example, PEG ratio, the longevity of the growth, and so on. Based on the shortlist and after doing further filtration in terms of management and valuation, we create a concentrated portfolio of around 20 to 25 stocks in our portfolios.
Oh,
So across our strategies, say ESOP to Rising Star, generally we notice that in the extreme scenario, we would have say only around 15 to 18 stocks, and in a slightly more diversified version, we will have between 25 to 30 stocks. So that's where I mean the you can say 15 to 25 is the broad range in which we operate. We have a research team. We have analysts who cover sectors of interest to us. So from these sectors, we are broadly able to cover around 20 companies more in the mid and the small cap space which we like, and we discuss these companies daily over a morning call, and we then do separate discussion sessions for individual companies with the concerned analyst. We do, I mean, like every other fund manager, we meet the management, we do variety of channel checks, we interact with experts, people in the ecosystem, meet the competition, do site visits, plant visits, and over time we build conviction in stocks that we like, and accordingly they form a part of the portfolios.
got it. That's a very good, I would say, a due diligence that you follow. I think like lot of other fund managers do. So also there is a term which is getting very popular, tailwinds, headwinds. A lot of investors are talking about that. So can you define it for our audience? Can you make it easy for our audience to understand? And how is Sundaram PMS, taking advantage of the tailwinds which exist in today's market?
Sure. So, yeah, these terms are used very frequently by everyone. Let me just simplify it for the audience. So, headwinds and tailwinds are basically factors which affect either the growth on the progress of a company or a sector. So, a headwind means basically a wind is in, uh, so you are walking in a one particular direction and the wind is flowing from the other direction, trying to slow you down. So, as you say, headwind means it is trying to slow you down. So obstacles or challenges that slow down your growth. It can be anything, like examples being economic downturns, say a lack of a majority government, a lack of clarity on regulation. So these are examples of headwinds. Global macro, for example, Trump tariffs that we all are very interested in, they are a headwind for our Indian economy right now on the export side, especially. So these are all headwinds. Tailwinds, the wind is flowing in the same direction as you are. So with tailwind will try to speed you up. I mean, even if you don't wish to, it will push you forward. So tailwinds are basically favorable conditions. They propel success. They increase the demand for your product or service. So examples can be like, for example, if the government is very supportive on certain industries right now, as it wants to make India Atmanirbhar, so it is providing regulations, it is providing incentives to put up facilities. So those are all tailwinds. So like we are seeing in the case of electronic manufacturing services. So that is, for example, is an example of a tailwind. In a business context, I mean, these dynamics are very crucial for planning and risk management in future. From investing point of view, these dynamics help us as fund managers to avoid certain sectors or be overweight on certain sectors. So if a sector is facing headwinds, so for example, the IT sector is facing a renewed headwind in the form of AI and now H1B visa issue. So therefore, I mean, they are going to face, that's a headwind for the sector. It is going to slow down the growth profile of even the best performing companies out there. Similarly, if you were to talk about a tailwind, for example, I already talked about electronic manufacturing services, right? I mean, the government is providing incentives and willing to bear burden of the initial cost. So, for example, we have seen CG Power setting up OSET facility. The
Right.
government is part funding this project, right? So that is what you mean by tailwind. Now, sometimes what happens is that what is headwind can eventually become a tailwind also, and vice versa. So I'll give you an example. Telecom sector, it went through multiple long-term headwinds, I would say, from 2010 to all the way to 2020. But the nature of headwinds also kept changing. So first, I'm sure everybody remembers the telecom scam, which emerged in the second term of UPA government. That became a headwind for the sector, and for 2010 to 15, there was hardly any interest in the sector. And you can see the share price chart of Bharti Airtel. It was basically moving sideways. I mean, it did not deliver return. And then from 2014-15 onwards, you saw Geo entering.
Correct.
What it led to was very heightened competitive intensity. So Geo simply slashed prices of the various data related services, and therefore it led to another round of headwind from 2015 to 20. So Bharti Airtel for 10 years delivered nothing, right?
Okay.
But something, a silver lining emerged out of all of this. What happened was, because of the high competitive intensity, all the smaller players were thrown out of the market. It got consolidated, and once the sector entered consolidation, and COVID led demand and data grew, it became a tailwind. So therefore, suddenly there was huge demand for data services and telecom services, and because there were only two three players left, they all benefited from them. So a headwind turned into tailwind after a point in time, and Bharti Airtel in the last 4 5 years has been a 4 to 5x kind of a multi-bagger. Imagine a large cap becoming a multi-bagger. So this headwinds and tailwinds become very important from an investing point of view as
Right, got it, got it. And also, a lot of investors are also, and sometimes I've also seen fund managers, they try to, put in which market cycle do we fall in. There is also one of the famous book from Howard Marks, Mastering the Market Cycle, if I'm not wrong. So, what do you think as a fund manager that which market cycle are we currently in, if you have any opinion?
well. Sure. It's a very tough question, I would say, because frankly speaking, the last few quarters, and interestingly, from September 2024, when the peak of the small and mid cap in India happened, to today, I think the markets have been flat to, I think, even negative. I think September is again ending on a very somber note. I mean, September initially started as a great, I mean, there was a huge relief, and because of GST rate cut announcements, the markets had bounced back. But in the last 2 weeks, if you have observed, the markets have given away all the gains that it made in the first half of the month. So that's what I'm saying. I mean, it's very difficult to predict what kind of a market cycle we are in. Nevertheless, let me just attempt, if at all. I will not know which kind of markets I can. What I can tell you is that it has become very volatile. So there are a lot of global and local factors that are continuously changing the dynamic of the market. So for instance, we have, who would have imagined that Mr. Trump would be so antagonistic to India, and all the bonhomie that Mr. Trump and Mr. Modi had at the beginning of the Trump second term would give away, would come to this point that, I mean, it was said that Mr. Modi was not even picking up his phone. So, I mean, just imagine what kind of volatility is there in the market, and because of this, sectors which were supposed to do well are suddenly facing headwinds, as we earlier explained, right? Now, despite all of this, there are still some sectors which are structurally on a long-term bull market. So, for example, at the very, you can say, at a 30,000 feet view, we can say that India is in the midst of a very long-term structural bull market in consumption, in financial services, in health and wellness, in manufacturing, and so on. Now, if you go further down, so if you come closer to earth, I mean, come closer to the ground, you will actually realize that while consumption is a very long-term enduring theme, but if you were to look at various consumption baskets, say FMCG or QSR, you will notice that we are struggling. I mean, these companies are not growing for the past multiple quarters now. Uh,
Correct.
Even in financial services, NBFCs were supposed to do well, but of late we are seeing renewed asset quality concerns. So while the long term, say 10 to 15-year view can be very positive, but when you come to a 2 3 year view, you will notice that there are pressures and challenges that even companies and sectors within this big theme are going through a lot of problems and so on. So one other thing which I would say is that uh, our market has become very selective again. So I would say in 2023 to 24, 2020 to somewhere between 2022 to somewhere until September 2024, the markets were very broad based. So we saw very good rally. It was value oriented rally. I mean, a lot of, I would say, uh, so-called poor quality companies delivered exceptional returns. Quality and I would say to an extent growth companies took a backseat. Therefore, if you must have observed, a lot of so-called quality companies like, for example, say a DMart or some other companies in FMCG, HUL, and so on, went sideways. They delivered no returns. At the same time, companies in sectors like, for example, I would say oil and gas, certain metal companies, tire companies, and so on. These so-called poor quality. Now, I'm not. I don't say anyone as poor quality or someone as good quality. Each company can be good quality at a right price. So, 2022 to 24 was a period where almost everything did well. Some companies which were traditionally doing well did not do anything. So, for example, say a Bajaj Finance, the so-called one of the best companies in NBFC,
Mm,
in terms of share price return, it went nowhere.
mm,
But say some other NBFCs did very well. Now the reverse is happening. It is again becoming a very selective market. So, for example, in terms of market cap, large caps are struggling to grow across sectors, be it FMCG, IT services, pharma, oil and gas, all growing in single digits but valued at much above their long term averages. Similarly, therefore, it becomes difficult to generate sustainable long term strong returns from these kind of sectors, large caps, say.
got it.
In contrast, mid and small caps, they are growing much faster than the large caps, but they are, I mean, one of the reason why mid and small cap companies are doing much better is because they are relatively smaller size. Therefore, on a lower base, they can grow much faster for longer time periods. But also, they are exposed to sectors which are actually growing. So, you get exposure to a much more a variety of sectors in the mid and small cap space because their size is small. They cannot be a part of the large cap universe also.
Got it.
But because these are the emerging sectors, therefore they are growing fast and therefore they will do well. Now, at the same time, there is one problem in mid and small cap also. What that is, over the last few quarters, we are also observing that within this mid and small cap space, the number of companies that continue to grow at a healthy rate, the universe itself is shrinking.
Mm,
So there were companies say in 2020 to 23 that grew very well. Now some of those companies are no longer growing at the high rates. So even within mid and small cap, the number of companies that are growing is reducing. That are growing fast is reducing by itself. So selectivity is happening on two fronts. One is in terms of market cap. Second, it is happening in terms of sectors. Third, it is happening in terms of uh, uh, even say I would say certain companies within sectors as well. So I would say the overall broader market cycle we are right now in is I would say being a selective market, a more of a bottom up kind of a market.
all right, got it. Now, a lot of investors have this query that should we wait? Should we invest? Is the market expensive? And there are some fund managers who are moving 100% into cash. That is also something which investors notice a lot. So, how do you feel as a fund manager? Every investor has his own appetite, every investor has own set of finances. And according to that, investor have to take decision. But as a fund manager, should investors be cautious? Should they wait or should they invest in tranches? How do you feel that?
Sure. No, I think this is a very relevant question right now. So, obviously, as I explained in my earlier remarks, there are certain companies which are doing quite well, are growing fast. And because everybody is trying to chase the same set of stocks, what happens is that the valuation of these companies which are growing faster than the overall market tend to become richer. So
Okay.
therefore, what happens is that even though the company may continue to grow fast, because of the starting valuations being itself very high, you are unable to generate similar shareholding share price return, even though earnings growth may be strong. Now, so lack of growth for several parts of the market, macro headwinds that we are seeing, and rich valuations for selective high growth sectors, it means that the overall returns for the markets have been muted. So as I told you earlier, September is again turning out to be a muted month. the last 1.5 year for the benchmarks at least. So for example, Nifty 50 or BSE 500, even that is now in negative territory. So you may feel as an investor that, I mean, if I'm not making any return in the equity, why should I be present in the equity? But see, you have to understand one thing: equity is never a linear asset. I mean, you remember, it never delivers steady returns every year. There will be years when it will generate very strong positive returns. So, and this normally happens after a bad year or a muted year, muted return for 1 or 2 years. So the subsequent year turns out to be a very strong year. And then there will be years where we will get very average returns, like say 10 to 15%, or in some cases 0 to 10%, and so on. So, but if you were to chart a 5 to 10 year period, you will observe that equities are generally among the best performing asset class. So they deliver the best returns of the various asset classes, and they help beat inflation in a big way. So equity is for the long term. You have to understand that, and I know it would sound cliche, but over 10-year time frame, generally any equity asset instrument, be it direct equity or mutual funds or PMS or EIF or a private equity, if they have got the right stocks in place, do some bit of churn to identify the sectors that are relevant, they will deliver above average and definitely better than benchmark returns. So there is one saying, I know, in the market, time in the market is much more important than timing the market. So
Mhm.
there may be some good fund managers who are able to time it perfectly, take cash calls, and then exit from market and then re-entering market. For people like us, I would say, who are lesser mortals, I would say regular investing, steady investing in the form of SIP or through tranches in case of PMS or AFs is the best way to go, because that helps you to average down your cost of equity over a period of time, and you will be able to therefore generate good returns over say 5 plus years. So for example, say post COVID, I mean, when the markets were actually attractive, or say post global financial crisis, those are of course very attractive entry points. But very few of us actually have the guts to invest at that point in time. Most of us would be following the herd mentality and would be actually running away from the market during those vulnerable times. But very few people actually have the guts to actually invest at that time. So I'm not sure whether people like investor, I mean, as a normal investor, would have that strength to call the bottom and call the top each and every time.
Right. And just I know one example because I speak to a couple of investors. So I was speaking to one investor. So he invested in March 2020, he invested around 1 2 crores. And then in May or June, he exited. So he has missed the entire rally which came, just by making a 5 10 lakh rupees gain on his investment that he did, he exited. So if he would have waited and, correctly timed, then obviously he would have kind of created multi-baggers in his portfolio. But again, you have taken a very relevant point that time in the market is more important than timing the market. So there are
Yes,
very few people who can, time the market, but timing is more important. So now
absolutely.
moving on to the next question, that do you still find opportunities in today's market, where you feel that mid and small caps have run up, or it's just the beginning of the next bull market which lies ahead of us? How do you feel?
Sure.
We have already
So,
recovered from COVID now, and from October 2025, 24 till March 2025, we have again seen a good correction in mid and small
yeah.
caps. So how do you feel that?
Absolutely. No, I mean, if you notice, from October 24 to now September 25, I think the markets have gone nowhere. The benchmarks have gone nowhere at least. But
Right.
if you were invested in certain sectors, you would have actually made money. Unfortunately for us, I would say we are among those few PMS houses which have delivered positive return in such a volatile period. So maybe ranging from 0% to maybe I would say 5 to 10%, depending upon the strategy. We have actually been positive and generated very good alpha over the benchmarks. So so the point is that, I mean, it see, one is that it pays to be invested for longer term. Secondly, it pays to be in the right sectors and the right stocks. And the sector leadership keeps changing over every 2 3 years, and therefore you need to be ahead of the curve in terms of identifying the next sectoral winners, and thereafter within those sectors identifying the right companies as well. And you can't be right all the time, there will be mistakes that will happen. uh, Coming to, I mean, mid and small caps, see, one is that you have to understand that uh, the small and the mid cap space, yes, are trading at much richer valuations compared to their own history, and are trading at a premium to large caps also.
Okay.
But what we have to understand is that in the long term, the market basically delivers returns similar to that of earnings growth. So if a company or sector is doing well, has got good earnings visibility, and is expected to grow well in future with good rates, then it makes still makes sense to invest in them, but have realistic expectations. So for example, in the power sector space, in power transmission specifically, some companies have delivered very good returns in the past few years. They have become, I think, if I were to talk about one stock, it has become 5x in the last, I would say, 3 years. Now, does it still make sense to buy them? Possibly, but don't expect 5 kind of returns. Expect that it will still continue to deliver around 20 to 30% CAGR return, but with a view that assumption that the multiples will sustain at current levels. We can't expect further expansion in multiple. So that is what we should now be looking at. That even though some companies and sectors have run up a lot, but it still makes sense to be invested in the same names, but with a reduced expectation that we will not get that historical return now, but we can still deliver, we can still get around the 20% earnings CAGR return. And secondly, also we also have to understand that we do not overpay for them. So we have to still check one thing, that our entry price valuations are not totally out of whack. While they may seem rich, but because of that strong earnings growth profile, the PEG ratio, as we call it, the PE divided by the earnings growth, it is still, I mean, within reasonable levels. So we did an interesting exercise. So if you see, valuation of mid and small caps are at a premium to large caps, but when you juxtapose it with the earnings growth, that is when you compare the PEG ratio, you will actually observe that mid and small caps are actually having lower PEG ratio compared to that of large caps. So the small and mid cap benchmarks are trading at a PEG ratio of around 1.5x broadly, whereas large caps are actually trading at 2 times PEG ratio. And if you remove certain low growth sectors within the large cap universe, like say an oil and gas or metals, the PEG ratio for the rest of the large caps is even higher. I would say at around 2.5 and so on.
Mm.
So it still makes sense to be invested in mid and small caps, because it has the sectors that are expected to do well in future, and because they are on a smaller base, they can grow much faster, be more nimbler than some of the large cap. Now, when it comes to whether we are having a new bull run in place, only time will tell. However, our job is to identify good long-term ideas across sectors, market caps, try and identify the sectors which have a good tail with, and then we ensure that we buy them at the right valuation multiples, and then finally give it time and patience to work its magic. So uh, that is what we can try and do from our side. So ensure that we are in the right stocks, we are with the right weights, and give it enough time, say of at least 3 years, so that the returns can be generated. One other point which is very important from our point of view is that we avoid making certain mistakes. So as much as possible, we also try and ensure that we are not in the wrong stocks or sectors. And if things are changing in our existing companies, be bold enough to take calls of like exiting from positions even if it is at a loss and so on. So we need to have that. I'm not saying we need to have hard defined stop loss limits, but be humble enough to admit that yes, mistakes are being made, exit from those mistakes as early as possible and stay with the winners as long as possible. So
Got it.
these are some points that I would like to highlight as far as investing in mid and small caps is concerned.
So I think that's a very good answer that you gave. Like the data point that mid and small caps are, much attractive when it comes to PEG ratio. I think everyone talks about that, but today, our audience also get to learn a new data point. So also now moving on to the next question that we have. So from past 1 week, whenever I pick Economic Times, maybe I think you must be reading that. So whenever we pick that, we find first 3 4 pages of the new IPOs which are coming up, right? Especially the private equity space looks quite attractive. A lot of investors are moving in Cat 2 apps also, especially running behind IPOs. So do you think that it's a bubble or there is a very big opportunity that lies ahead of us? What do you feel?
So I would say India is blessed that we have so many companies across multiple sectors which are coming up for listing, and the pace of IPOs has only been growing. I mean, the number of IPOs that come to the market, if you plot the chart, you will notice that it has only been increasing over the years, which is a good thing to have actually, because that helps that our market to become broader and deeper. I mean, you must have observed that, I mean, Bombay Stock Exchange, I think, has more than 6,000 companies which are listed. Not all of them are worth investing. Some of them are just like they got listed, but there is no business. But nevertheless, even if you were to assume, say, 50% of that 6,000 is of relevance, we have 3,000 companies to invest in. And this universe is only expanding with more IPOs, more corporate actions, demergers or spin-offs, all of that. So that helps improve the breadth and depth of the market. Now, every few years, you will notice that there are some new sectors which come up for listing. So, for example, in 2016, we had various staffing services company which got listed. Then we had life insurance companies which got listed. Then we had Dixon, Number, basically the first leg of the EMS companies. And then in the last 3 years, we saw the rise of more EMS companies coming into the market uh, in a very niche way. Uh, in the last 3 4 years, we have also seen some of the some of the unicorns becoming mature and coming to the market. So we have Paytm, Zomato, Policy Bazaar. So just imagine there are so many more platforms yet to come into our market, like say a Meesho or Zoho,
Right.
this new favorite in town. So there are so many more yet to come. It's always good to know that, I mean, India has such an entrepreneurial spirit that it leads to so many companies, each with its own unique business model and doing well for itself. So it's always good to have more and more companies so that our market is more deeper, broader, and see, also look at it in another way. We have such a strong domestic inflow. People are warming up to the concept of equity investing, and people are doing so much SIP now that our monthly SIP book has become almost 28,000 crores. Where all this money needs to get deployed somewhere. If we were to have a very shallow market, imagine the valuation multiples. I mean, right now we are worried about valuation multiples, but if there were not these IPOs, all of this liquidity would chase the existing companies and the valuation multiples would have only kept going up. So it's good in a way that we have so many companies coming up. So I would say let the good times continue as far as IPO markets are concerned. When you talked about private equity, see, I mean, don't think of them as like, I wouldn't say there is a bubble or anything. The private equity guys are smart enough to identify what is a bubble, what is not a bubble, and uh, yes, there are some funds which have just been launched in order to capture the pop-up in case of IPOs or pre-IPOs. But I think there is enough good work being done by a lot of private equity investors who are identifying the next big theme or sector and identifying unique business models. See, they are taking the much more risk than we listed fund manager participants. You understand? They are
Right.
taking much more risk compared to us, and uh, even if some of so if they have say around 10 investments, maybe two or three go on to become good multi-baggers. Many of them fall by the wayside. So but those two three more than make up for the failures, and they in turn help them generate the good returns. So it's good to see that our markets are not just about listed equities, but there is a vibrant venture capital and private equity market which is identifying the best themes for the listed participants and preparing them for the eventual listing. So overall, let the good times continue.
Got it. So, any moving on to the next question, do you think any specific sectors, industries that you find very interesting for next 3 to 5 years, and which excite you about India next couple of sectors that you feel would be good, and any are there any sectors which you as a fund manager are avoiding right now?
Sure. So, look, there are many sectors that are expected to do well over multiple years, multiple future years, I would say. I would just like to highlight one theme that has worked well for us and we continue to have a positive view, that is of power generation and transmission. Now, for the large part of last decade, uh, power as a sector saw significant underinvestment, especially generation in the traditional thermal capacities because of the coal scam and the subsequent push towards renewables. However, now people have realized that the demand for power has continued to grow with the rise in economic, with the rise in income levels, and therefore the subsequent demand for power from say use of ACs, refrigerators, TVs. Now with manufacturing in India theme along with the AI and the data center led demand, power demand is in fact set to rise even further. Now, therefore, you need not just solar capacity, which is already being deployed in a big way, but you also need thermal capacity in order to ensure that the base load is maintained, right? So, therefore, both generation and transmission companies are set for good times. We have got a very good exposure to multiple companies in this entire ecosystem. So we have got some of the equipment suppliers for transmission. We have got the equipment suppliers for generation. We have got the ancillary companies like say the power cable companies and so on. So we have got investments across the entire ecosystem of the power theme. At the same time, there is another theme which I would say doesn't really classify into any one sector, but I would say call it like as a horizontal theme. What do I mean by horizontal theme? Just to give an example, we have several niche manufacturing companies spread across sectors in India which are doing some very critical work, or I would say providing a critical component or product to their clients, and be it in areas of chemical or pharma or engineering goods. So these companies have again done well. They have continued to have very strong order books and have got good financial profile. They are undertaking big capex in order to meet future demand and so on. And interestingly, these are companies which have not been impacted by tariffs and all that. Yeah, even though they are supplying goods and services to US. In fact,
Mhm.
post the announcement of 50% tariff, one of our portfolio companies in this area got another order from a US client. So you can imagine how critical that company is from a supply chain point of view, that even after tariff, he is willing to give big orders to the company. Uh, at the same time, we continue to avoid certain sectors. So, I mean, because we want high growth companies, naturally large cap companies fall out of favor for us. So, therefore, FMCG companies have been, not been a part of our portfolios any which ways. They are also facing disruption from new age B2C companies who are more nimble and faster to adapt compared to the large cap FMCG giants. Not to say that they are not taking any actions, but from their overall business point of view, those small initiatives don't make a dent in the overall earnings profile. Similarly, IT services companies, if you notice, are going through one of the most challenging phases. So it's not just about H1B visa issue. It's also about US macro not in their favor in terms of demand and AI disruption, which is creating a big challenge to their entire business model right now, right? So it is a deflationary scenario in terms of their revenue and margin profile. So these are some sectors where we don't have much exposure, and these are sectors we have avoided.
Got it. So now you were speaking about tariffs. So if how do you think that these global events, or Trump saying something, then China slow down, then Middle East tensions actually affect your strategy here in India? Does it affect your strategy? And if yes, then how?
Sure. So see, every global or local event, they do tend to influence the market in the short term, and you must have noticed that post the announcement of tariffs, the Indian market corrected significantly, and thereafter, once Mr. Modi announced GST rate cuts on Independence Day, there was some bounce back. So, be it a global event or a local event, they tend to influence the market. In the short term, it results in heightened volatility. So you will see share prices moving up by 5% or down 5% one day. But some of these events tend to play a bigger role in shaping the future return of, I would say, entire asset classes also, or even certain sectors. And some of them are transitionary. They create noise or distraction, and thereafter they fade away, and people eventually realize that it was just a noise and it didn't change anything. So, just to give you an example, uh, for example, I mean, the Indian elections of 2024, they created a lot of noise. But once markets realized that the Mr. Modi was able to come back with a lesser majority and a stable government was formed, the market moved on and stocks bounced back. However, there are certain things like, for example, the Fed actions, they have a lasting impact because the Fed rate cuts create positive or negative liquidity events in the world market, which then subsequently has a similar impact on the entire risk asset classes like equity and crypto and so on. So if Fed rate cuts, if the Fed cuts rates, then it creates better liquidity for the world markets, which in then flows into, say, US equity markets and then subsequently to the other emerging markets and so on, or say gold and crypto and so on. If it decides to hike rates, it means that, I mean, uh, things are running out of control and possibly it leads to a risk of environment in risk assets like equities or cryptos and so on. Now, geopolitics is a very interesting subject. I mean, and we can go for hours about this, but just to highlight a few important things, it plays a big role in shaping world events and shaping the future returns of various asset classes, including equities. And it creates some butterfly effects, I mean, which is very difficult to determine in the initial years, but then becomes very obvious that array, this was expected once you after 2 3 years. And one of the key example I would say is that of gold. So see, what happened was that in 2022, after Russia invaded Ukraine, you must have observed that US and European Union decided to freeze the forex assets of Russia.
Hmm.
Okay,
Yes.
that one event made other central banks of China, India, and other big economies realize that we cannot trust our foreign assets in US dollar. So what has subsequently happened is that, I mean, they have resorted to buying gold every month in huge volumes, and that is why today gold prices are on a tear. For a few months, once they started buying, gold prices were at around $2,000 per ounce. But now today, in the last 3 years, I would say gold has touched almost $3,800 per ounce. So you can imagine that this kind of an event, even though it was initially not obvious, now it is very obvious that yes, you need to diversify away from US dollar and need to have your forex assets in multiple currencies and multiple precious metals, and gold being the most in demand. Another example, like for example, very short term maybe tariff. So tariff is going to impact our exporters adversely in the next 1 to 2 years till the time they figure out alternative markets for themselves, or if Indian government is able to negotiate a good deal for both sides. So it depends. I mean, it depends on. So there will be some which are transitionary, some which have a very long term effect, and then there are some which are simply noise.
Got it. Got it. And also, one question that I have from investors' point of view, in your strategy that you follow, do you focus on bottom-up investing regardless of whatever noise is happening in the macro environment?
So I think both have a role to play. Both are different sides of the same coin. Top down basically means global and local macro factors, which I talked about just now. And then there is the other side, which is bottom up stock picking. So both are important. Top down helps us to identify long term and short term structural and tactical themes and sectors. Now within those tactical or structural themes and sectors, then you bottom up helps you to identify the right companies within those selected sector or theme and so on. So I think both are important. Both play a role in investment decisions.
Got it. And are there any global trends that you are seeing, like say AI, green energy, supply chain shifts that are happening from, you can say, China to India, that you think will create a long-term opportunities for the Indian companies?
So, I mean, all of these are themes which are already underway,
Right.
both globally and in India. And like, for example, AI, there is now clearly a geostrategic war taking place on AI between US and China. And the DeepSeek movement, which happened in January, was an example of the same. Same way, I mean, green energy, it started with China. India has picked it up. Now, India is doubling down on the green energy and the sustainable energy theme. The China plus one theme has been talked about for long, especially post COVID. However, China continues to dominate most parts of various emerging themes. India can find its own niches within this and be strong in certain areas. So, for example, from our Indian market point of view, we have companies which are already present and doing work on these various themes like green energy or just China plus one, which is, I would say, light engineering goods companies or certain CRDMO or pharma companies. So there are certain companies which are already playing this theme. Um, so just to give you some examples, so uh, you will see a lot of these themes are actually right now in the unlisted space. So many of these themes like AI or green energy or China plus one data centers, CRDMOs, a lot of them, aerospace defense is another big example which we have not talked about, new age platform. All of these are, there are a lot of companies already in India which are in the unlisted space, are doing some really interesting work. um, some of these companies have started to come into the listed market, and many a times they are backed by private equity promoters who have to exit because they are reaching their end of life in terms of the fund that they are running. So therefore, there are a lot of companies which are coming up. So, for example, last 1 year we have seen so many solar ecosystem plays getting listed. Pari Energies, Premier Energies, then
Right.
just today
Right.
Solar World got listed,
Okay.
Insolation Energy. So many such companies got getting listed in the past 1 year in solar. Similarly, we saw some CRDMO companies getting listed. So, for example, Anthem Biosciences, Sai Life Sciences. So a lot more companies, certain companies got listed in a by merging it their unlisted company with a merge with a listed company. For example, Cohan's Life Sciences and CRDMO is a merger between one listed company which was Suven Pharma and Cohan's, which was an unlisted by the same private equity promoter. So people are finding ways to bring them out. We have also seen the rise and listing of certain interesting aerospace and defense companies also in the last 1 year. And you will continue to see many such companies, not just within this name themes that you named, but even otherwise. So, for example, you will very soon see some companies from the IVF space which might get listed, certain more CRO companies like clinical research outsourcing and all of that. So there will be a plethora of new interesting companies that will keep coming up for listing. And it's not just that it will be only through listing or IPOs. Some in some cases, even established listed companies have taken note of these big trends and are taking steps or pivoting their business models to take advantage of them. So, for example, just to give an example, while we now have got Ola and Ether listed on the Indian market,
Hmm.
but we are also forgetting that Bajaj Auto and TVS Motors have created a very good electric scooter platforms,
Yes.
and they are in fact now among the top 3 or 4 players in the electric scooter space. So it's not that the listed companies, established powerhouses are lying idle. They are also taking a lot of actions and steps to stay relevant. So
Got it.
same way, for example, Mahindra and Mahindra and Tata Motors, they have launched such beautiful and strong electric four-wheelers, right?
Right.
So, I mean, and this is just one example. There are several such examples across sectors where both listed or through IPOs, we are getting to play these themes now.
Got it. I think that you have put it in a very right way, and you have humanized it so that our audience can understand it in a very simple way. So now a lot of NRIs we work with, ask that India is still a domestic consumption story, or whether we will see that export-led sectors such as IT, pharma, chemicals will, drive the next big wealth creation that is about to happen. What's your take on this?
Yeah, so look, I mean, our Indian economy has always been a domestic oriented, consumption driven economy. And
Correct.
uh, I like to use this example of festivals, right? I think our forefathers and the way our economic life was shaped in thousands of years ago, we I think created events and festivals in order to ensure that there is some economic activity happening throughout the year, so that there is always some demand and some growth happening, right? So we have festivals right from Holi, then we have Shravan, then we have got Ganesh Chaturthi, Navratri, and then Diwali, and then Christmas, and then again the
Mm.
next cycle starts, right? And of course, we have got the the Muslim festivals also that are present. So we have got festivals across religions, which in a way help keep driving consumption, right? And people tend to spend because that is the way you enjoy life, right? So it is good for the country and for the economy that there is continuous demand for basic services and goods, and then as you prosper economically, you try to premiumize. So that is the way the economic cycle continues. From exports point of view, look, I mean, China has been the dominant export powerhouse in the world, and India had its strong areas in form of IT services and pharma, and then in manufacturing in certain sectors like light engineering goods, textiles, gems and jewelry, etc. We have created certain niches, and we are present in a decent way. However, over time, our companies are also upgrading. They are moving up the value chain. So, therefore, over the long term, hopefully, our export should become a larger part of the economy than it is currently. Nevertheless, right now we are facing tariff headwinds. So, this has slowed down the progress of our export oriented sectors, and therefore, growth is slow in the near term. However, if we are able to get good support from the government, I don't see any reason why India as a whole can continue to generate new companies which become very niche, specialized in their areas, and become globally competitive and continue to do well despite the tariffs or any other headwinds that may come in future.
Got it. I think now we have just the last question on table. So, it's for the investors. So a lot of investors, get anxious after seeing their quarterly performance or monthly performance in a PMS. And as articulated very well that returns in the equity are not linear. They will, you have to see drawdowns if you have to see the best times as well. So how do you, kind of a message that you have for the investors, who get very nervous seeing the monthly performance? And how they should stop taking some emotional decisions, and they should trust the process that our fund managers are right, and the strategy that we have selected is also as per our needs. So that's the last message, and then we'll wind up.
Sure. Yeah, I think this question is very important for everybody. Look, as I explained earlier, right? I mean, you need to have a long-term patience and need to have that long-term orientation in order to benefit out of investing in equities. At the same time, from our side as fund managers, we also need to set realistic expectations
Correct.
for every prospective investor or even for our existing clients. We need to have regular communication with them. We need to explain them regularly our views on the market and informed outlook on the future. It can be wrong. I'm not saying that we are always right, but at least if we inform them about what we are thinking in simple languages, and if our actions that we take in the portfolios collaborate or corroborate with the our views on the market, I think it can help them assuage their concerns and calm their nerves. So it requires them, you need to set the expectations right and set realistic expectations, not have just because you saw 20% kicker return in the past 5 years means you will deliver. That is a wrong approach. You should need to say that okay, the markets are overheated right now for the next 1 year. Maybe you will not see much return. But that should that mean that you don't invest? No, you should be invested, but just that don't expect immediate returns, right?
Right.
The last 4 5 years returns they have spoiled the mindset of investors. The people tend to think that every year I will get 15% return. If they see that 18% since inception return, they will think that I can get 18% in future also. Of course, we will try to achieve that, but it is not easy, right? I mean, equity investing is not easy. It is marked by ups and downs. And for example, the last 1.5 years is a good reminder that returns don't come easy, and it requires a lot of patience and a long-term view in order to get good double-digit CAGR return of say around 15 to 20% on a sustainable basis. So,
Right.
so long-term approach to investing, being patient, having realistic expectations. I think I have these 3 4 things if people keep in mind, I think it will help them to have a very right approach to investing in equities, be it in mutual fund or PMS or AI. And one thing is that, I mean, we cannot check returns daily, right? I mean, one day the market will be down 1%, second day it will be up 0.5%. So as we call it in theory, these are all random moves. It's very difficult to make any prediction out of these random moves.
Right. So I think, you have articulated the entire webinar very well, Darshan. So it's glad to have you. I think it was a very helpful for me as well as a lot of our investors who watch us. So thank you for your time and really appreciate, you coming to our platform. Thank you so
Thank
much.
you so much, Gitansh. Thank you so much.
Thank you, Darshan. Thank you. Have a nice day.
Thanks.
Bye.
Yeah, same to you. Bye bye.
Bye.